And joining us now for the latest on tariffs and the recently passed budget bill and more, Treasury Secretary Scott Bessent. Secretary, thanks for joining us. I don't know how much you could necessarily hear of our last conversation. We definitely want to talk trade, tariffs, and all of the above, but let's keep the discussion going about the big, beautiful bill, deficit concerns, debt concerns. You have made the argument in the past that this will address the deficit, and you see deficits in future years coming down from whatever it is, 6% of GDP. How do you argue that that's going to happen? Tell us again.
Well, good morning, Joe. And look, we inherited a mess, and I'm not sure where all these deficit hawks were when Team Biden was blowing out the deficit. So last year was 6.7% of GDP, which was the highest it had been when we weren't in a recession, we're at war. And as your previous guest said, we don't have a tax collection problem, we have a spending problem, and we're trying to get that under control. We are also trying to accelerate growth because changing the growth trajectory upward solves a lot of the deficit problems.
Mr. Secretary, I asked the question that not all deficit spending is equal. I don't think. And would you argue that if a deficit resulted from lower tax rates or from extending the tax cuts, whatever you want to call it, if it can cause some growth, is that superior to the deficit, or is it less deleterious than the deficit you get just from Green New Deals or IRAs or whatever you're talking about, the government, just transfer payments and the like?
Well, Joe, you're exactly right. Does the spending create more growth, and is the GDP growing faster than the deficit? One of the things that I agreed with Secretary Yellen on, the important number is the debt to GDP, and we intend to bring that down. We also intend we cut spending. On the IRA, there's substantial pullbacks. A lot of those were uneconomical, stranded assets. And the Trump economic agenda, as I've said many times, it's a three-legged stool. It's trade, it's tax, and it's deregulation. So, I also believe that the substantial amount of deregulation that we're doing is going to accelerate economic growth. And the important thing, too, is we're going to have economic growth in a non-inflationary manner, unlike we saw in the previous 4 years.
Let's move on to trade. And it's amazing how quickly things move. I know yesterday you said by Wednesday we might have a couple of more deals to announce. I know it's Monday, it's not even 9 o'clock yet. Can you give us any idea whether that's likely? Is India, is that in the mix? Can you break any news for us here that something's going to happen in the next 48 hours?
Yeah, we are going to have several announcements in the next 48 hours. And, Joe, I think what President Trump is concerned about is the quality of the deals, not the quantity. As you could imagine, as he started herding the cats and trying to get everyone across the finish line, when he said that there's a chance that countries could boomerang back to their April 2nd reciprocal tariff levels, we've had a lot of people change their tune in terms of negotiations. So my mailbox was full last night with a lot of new offers, a lot of new proposals. So it's going to be a busy couple of days. But importantly, too, that President Trump has said that the countries would not go back to the reciprocal rate until August 1st.
Mr. Secretary, question on behalf of a number of viewers who are in business importing things from Vietnam, and they want to know the following. They say this 20%, is that on top of existing duties? Is it 20% overall? What is the actual number? Because I think there's a lot of folks who are still confused or trying to do some planning here.
Andrew, 20% overall.
20% overall. So there's nothing that's not tacked on to something else before that.
No, this supersedes all the other tariffs. Now, there may still be some of the 232 tariffs for specific industries, but in terms of generalized, it's 20%.
Mr. Secretary, I think you took, or at least it was interpreted, it was a softer tone on what's going to be included in the letters that go out on Wednesday. What can we expect? What are they? Is it ultimatums and the president's way of the highway with some of these numbers, or are there details on I don't know, sort of staking out positions and letting these countries know what where they have more work to do?
No, they're pretty standard letters, Joe. It's just thank you for wanting to trade with the United States of America. We welcome you as a trading partner, and here's the rate, unless you want to come back and try to negotiate.
The one thing I've noticed that a lot of people that don't want any tariffs and are the most critical of the entire approach to trade are the ones that seem most disappointed when the president doesn't follow through on the tariffs that he's promised. So when it appears that he's trying to do deals and trying to, I don't know, negotiate from a position of strength, they're the first ones to criticize him for not following through with the really draconian tariffs that we all hope doesn't come to pass.
Well, Joe, as I've said over the past few weeks, TDS, which used to mean Trump Arrangement Syndrome, has turned into Tariff Arrangement Syndrome. And this same group was polling for the economy to slow, for inflation to pop up. None of that has happened. None of that has happened. And as a matter of fact, we're taking in substantial tariff income, which I don't like the CBO scoring, but some Democrat made the mistake of asking the CBO to score tariff. And over the 10-year window, that's $2.8 trillion based on the current deals. And I can tell you that the deals that are coming out will be slightly higher than that. So again, I don't like CBO scoring, but $2.83 trillion over the 10-year window substantially eases the deficit.
Mr. Secretary, you are an incredibly busy man. I think your portfolio is more expansive than any Treasury Secretary I recall ever seeing. I just wonder, what job do you think is more important to the markets, to the economy? Would it be Treasury Secretary or Chairman of the Federal Reserve?
Look, they're both very important jobs. I am busy as Treasury Secretary. Becky, I think you're asking which is more important for me to do.
I am.
Okay. Look, I will do what the president wants, but I think that we are making great gains here at Treasury. We've had a busy 5-6 months out of the blocks, and we've got a lot to do. Passing the One Big Beautiful Bill on July 4th was an incredible achievement by the president, by Speaker Johnson, by Leader Thune, but now Treasury is tasked with the implementation.
Mr. Secretary, as you think about interest rates, we've heard from the president talking about what he would describe as too late Powell. Powell is not going to be in this job in a year from now, no matter what. And one of the conversations we had with Steve Leisman last week was the idea that maybe the market has already built in almost the shadow-fed idea that you raised about a year ago before the election in terms of how the market thinks. Do you think that interest rates, to the extent they have been kept down, irrespective of what the Fed is doing, or at least the expectations of what the market thinks, is a function of that?
Well, and I always say markets live in the future, and I think markets may be pricing in that perhaps the president's right, that rates should be lower. I would say that the market's pricing in lower, I think it's 2 cuts for the rest of the year, and then the 2-year, the overnight and the 2-year are inverted. So maybe the market's just pricing in the economic fundamentals, and sure, is a different Fed share is a kind of forward guidance, but as I reiterate to people all the time, it's not just the Fed share, it's a committee.
By the way, what are your lunches like with Jay Powell these days?
Well, it's breakfast, and we have a lively exchange. We do a home game and away game. He comes to Treasury, I go to the Fed. The Fed's food is much better, so I enjoy breakfast over there. And we have very lively and far-reaching discussions with a lot of mutual respect.
They can spend as much money as they want on breakfast at the Fed. They're printing. It's like anything goes. It's like,
They're not worried about egg prices over there.
Are people actually leaving tariff offers for you on your voicemail? Or was that?
They're coming in a lot of different ways, Becky.
That's curious.
Yeah. You're, at this point, you're still Treasury Secretary, so I need to ask you about the dollar. And it actually is it's sort of an issue that, the markets are at new highs, equity markets, the bond market has been behaved after the big, beautiful bill. But people looking to nitpick or looking for something to really be concerned about, talk about the dollar's behavior since the beginning of the year. I think it's the worst start of a year in 30, 40, 50 years. Was it overvalued, Mr. Secretary? Was this long due? And given the recalibration in global trade the president's trying to effect, is this to be expected and actually welcomed?
Well, Joe, I was in the investment business 30, 40 years, and more than half my gains came from currencies. So I think I have a good box to stand on here when I talk about currencies. And I can tell you that it's natural for currencies to go up and down. And what we've seen is not out of the ordinary. Maybe the speed with which it happened, but again, these days things seem to happen much faster. After the bottom in the stock markets on April 9th, we had the fastest recovery from a 15% drawdown in history. And I would point to President Trump's first term. Over the first year, the dollar went down about 7%. When Tax Cuts and Jobs Act were passed in December, then over the ensuing few years, the dollar went up. And the value of the dollar, it could mean that other countries' currencies are strengthening. The index that you're referring to is the DXY. The largest component of that is the euro. And one would expect that the euro would appreciate given the fiscal spend that we are seeing coming out of Europe, especially on defense and especially from Germany. The other thing that's happened, we have seen a substantial depreciation in the Chinese currency, the RMB versus the euro. So I believe that's down at about 11.5% on the year, and it's just hit an all-time low. So, I don't see people waving their hands in the air about the Chinese currency depreciating.
Mr. Secretary, I wanted to just ask you about China. About a week ago, President Trump referred to a potential deal over TikTok in the next 2 weeks. Some people looked at that and said that's an interesting chess piece as part of the larger negotiation with China. What is the timeline at this point with China? Can you give us any sort of sense of how things are going there?
Andrew, one of the things that's not my portfolio is TikTok, so I can't speak to that directly. What I can speak to is I'm going to be meeting with my Chinese counterpart sometime in the next couple of weeks. We had good meetings in Geneva, in London. We both approached it with great respect to the two largest economies. And I think there are things for us to do together if the Chinese want to do it. So we will discuss whether we are able to move beyond trade into other areas.
Secretary, I know you have to leave. I was kind of clumsy in asking my question about just trying to talk about different types of deficits. Judy Shelton, I don't know what happens with the Fed. I don't know who's there in a year, but this is pretty eloquent. She sent this in. This has been one of her Wall Street Journal pieces. There is a difference between government overspending, which borrows from the future to pay for current consumption, and tax-cutting incentives now to spur more production down the road. Government borrowing to finance socialist redistribution isn't the same as government borrowing to invest in entrepreneurial capitalism. That's pretty well said. I might tweet that out. You're free to tweet that out if you want to.
Okay, Joe, the other thing too is that I think in the Tax Cuts and Jobs Act, which was made permanent, is the 100% expensing of
That's not talked about much.
Which is very powerful. We also have a 5-year window for 100% expensing for factory structures and agriculture structures. So to take a tax hit on that is really, you're really winding the spring, and you are creating high after-tax returns on capital, which increase productivity, which is what makes countries rich.
Very good. Let us know. We're here if you want to get it out. I think we count as disclosure, don't we? We count as fair disclosure. If you're leaving now and you get something in your email box or something, just call us back. Will you do that, Mr. Secretary? Let us know.
After
Maybe
the
not.
president, Joe, you'll be my second call.
Right. There you go.
That's not bad. Thank you, Secretary Bessent. Appreciate it.
Okay. Thank you all.
Okay. Coming up, Elon Musk saying he's launching a political party to compete against the Republican and Democratic parties. The announcement sending Tesla shares lower in the pre-market this morning.
Markets live in the future, and I think markets may be pricing in that perhaps the president's right, the rates should be lower. I would say that the market's pricing in lower. I think it's 2 cuts for the rest of the year, and then the 2-year, the overnight and the 2-year are inverted. So maybe the market's just pricing in the economic fundamentals. And sure, is a different Fed share is a kind of forward guidance. But as I reiterate to people all the time, it's not just the Fed share, it's a committee.
That was Treasury Secretary Scott Bessent earlier on Squawk Box. It's no secret that President Trump is frustrated with Fed Chair Jay Powell over interest rates. That was the Secretary talking a little bit about what he would see happening in this scenario. Of course, he's been mentioned as a potential Fed Chair replacement. For more on this, we want to bring in Ken Rogoff. He's professor of economics at Harvard University. He's also the author of Our Dollar, Your Problem, an insider's view of 7 turbulent decades of global finance and the road ahead. And Ken, first of all, welcome. It's really great to see you here. You are a chess master, and you've spent some time gaming out this idea of a shadow Fed chairman. You're not a huge fan of it. What are the problems in the setup as you see it?
Well, I don't think having a shadow Fed chair who's going to be Fed chair is going to influence the Fed all that much. I think what Secretary Bessent said about a bit of forward guidance on what the chair might do, that's correct. But also, the shadow Fed chair is having to say at every moment what they would do. And if it's not in line with what Trump would do, then he can unnominate him. And so in a way, it paints the shadow Fed chair into a corner. Trump, I think, has said he wants the rate to brought down to 1%. I don't really see how that's consistent with the growth he foresees without having a lot of inflation in this economy. So it's very clever in a way. He's going to appoint the Fed chair. He won't control them. He's seen that with the Supreme Court justices, and he's trying to paint them into a corner. But I don't know that if he's wrong about the interest rates, that they really need to stay somewhat higher, that's going to prove a good thing for the economy or for President Trump.
You thought up an interesting scenario that had not occurred to me, and that's what could happen potentially if there is a shadow Fed chair from within the Fed, and that being Jay Powell. If he doesn't step down, he may not be chairman, but if he doesn't give up his seat, what happens?
No, that is such a good point.
That's your point.
If Powell doesn't give up his seat, if Powell doesn't give up his seat and stays on the board, and Trump appoints someone who the rest of the board doesn't respect, I think if they respect them, they'll give them a lot of rope. They'll go along with them. But if they don't respect them, Powell will be the shadow chair from within the Fed, and the Fed chair may not control the board. Again, just a few minutes earlier, Secretary Bessent acknowledged that it's not all the Fed chair. You have to persuade the entire Open Market Committee.
All right, you've got a book that's out talking about, Our Dollar, Your Problem. And we did bring this up with Treasury Secretary as well, just the idea of the pressure the dollar has been under this year. You think that weakness will continue. Why?
Well, Trump inherited a very high dollar. And I'm looking at given cost of living, other measures of how expensive it is in a country. We haven't seen the dollar this high since 2002, 1985. And both times the dollar, not overnight, but over a couple of years, came down very far, I think 40% by some measures after 2002. So sure, it's down 10%, but it's still very high. I mean, ask somebody in Japan where they've had no inflation compared to us, and yet the yen has fallen a lot, how expensive it is in the States. And I think if you look around the world, that's still the case. So sure, Trump's actions have probably accelerated, excuse me, a move that might have happened anyway, but the dollar is still high. So even if Harris were president, I think it would be coming down.
And the implication of that for the economy, for the markets?
Well, I think actually it's probably fine for the United States. We're interested in having the dollar still be the lingua franca, the reserve currency. My book argues that's being chipped away at, and there are other things Trump is doing. But having the dollar come down is fine. That's one place where I agree with the president's instincts.
What you are a little concerned about is what happens with Treasury yields. Even with the pressure to lower rates, you think that yields are more likely to go up than down from here. Why is that?
Well, we're looking at global borrowing, not just U.S. borrowing. Look at what's going on in Europe, Japan. China may need to do something to pull out of its doldrums. We're looking at the need for AI in many countries for, if not stopping climate change, dealing with climate change, the global fracturing, home shoring. There's a lot of pressures on investment. And I think the real underlying interest rates going up, and real interest rates have gone up dramatically the last couple of years. And I don't think anything the Fed chair can do is going to dramatically bring that down. At the same time, interest rates, aren't reflecting a high inflation expectations. Maybe they're right, but that's one of the ways this mess can end. It could also end in financial repression, which pushes down interest rates. So maybe that's what's going on. But I would see the balance of risk to be interest rates at the long end rising. Certainly the Fed rate's more likely to go down than up. But at the long rate over the next couple of years, I think it's going to continue to go up.
Which is bad news for anybody who wants to buy a house with a 30-year mortgage, bad news for longer-term debt that we're taking on, and probably bad news for American taxpayers who have to pay off the debt.
Yeah, absolutely. I mean, we would like interest rates to stay down. Mind you, just to be clear, it was much better that this tax bill, this new big, beautiful bill got passed than if it didn't. That would have been a massive tax hike. It's not really that we had a tax cut. But the American voter hasn't really come around to the idea that we need to rein in the deficits. People like me may say it, Bob Rubin, some of you may say it, but I don't think the American voter is there yet. And until they are, and that might happen until we have an inflation crisis or something, I don't think we're going to do it.
Okay. Professor Rogoff, thank you for joining us. We appreciate it.
Thank you for having me.
Up next.
And I think markets may be pricing in that perhaps the president's right, the rates should be lower. I would say that the market's pricing in lower, I think it's 2 cuts for the rest of the year. And then the 2-year, the overnight and the 2-year are inverted. So maybe the market's just pricing in the economic fundamentals. And sure, is a different Fed chair is a kind of forward guidance, but as I reiterate to people all the time, it's not just the Fed chair, it's a committee.
Oh, there it was. Treasury Secretary Scott Bessent last hour on Squawk. The White House keeping up the pressure on Fed Chair Powell, but in a very convivial way, I think, including this morning, with one advisor penning an op-ed that goes as far as to say that Powell could be the worst Fed chair in history. I question the hyperbole, Carl, but you never know. Because joining us now to explain as well as share the latest on trade talks, Senior Counsel for Trade and Manufacturing, always a strong voice for the President, Peter Navarro. All right, Peter, I'm going to give you the floor.
Great pleasure to be with you, Jim.
Thank
Great pleasure
you.
to be with you, buddy.
And the same, and you know that. And I feel
Yes.
that way. I read your piece. I said, okay, here's a person that has strong conviction on Fed Chair Powell, and I'm going to give you the floor to describe your view.
Yeah, well, let's start with what the stakes are. If he's too high at the Fed, let's say it's like a half point now too high. That's like anywhere from a quarter to a half a point of GDP growth that we're going to lose. In other words, we're going to grow more slowly. It's like $100 billion that costs our economy. And then when you trickle it down to the interest rates that people pay, it's about $100 billion in added debt because we're refinancing debt. So it's not small potatoes. Now, in terms of the argument, let's see if we can agree on two things, right? I claim in the Hill piece that Powell has made three major blunders. Let's see, Jim, if we can agree on the first two. When we were in the first term with President Donald Trump and we had the tariffs and the tax bills and the whole Trump-nomics going on, Powell raised rates too high. And by the Fed's own analysis, that cost us a lot of growth. So let's see if we can agree on that. And then when he was serving the Biden regime so well in a partisan way, in my judgment, he didn't raise rates fast enough. He let them get out of control. He also kept his mouth shut. Well, the Democrat Congress was passing these massive expenditure inflationary bills, and he was too late Powell then. He was too early Powell in the first term. Can we agree, Jim, that those blunders happened? Is there any doubt that Powell was wrong twice in the earlier years?
I'm going to say no. I think there's a lot of time in between that he did things right. I totally agree on 2018. Was very against that. When it comes to what happened in terms of transitory or not, what I think it was an honest mistake. I will not give you that it was partisan. I will just say it's an honest mistake, but I think you,
but
as
it was
you
a
said,
mistake.
in my judgment.
But it
you
was
said
a
in
mistake.
my judgment.
Okay.
Yes.
So
it was a
he's
mistake.
made two big mistakes so far, and now the third one is the question is, Jim, which isn't it? It's like rates should be lower. The markets are telling us all of that. Powell is doing the same thing he did with the first term of Donald Trump. He doesn't understand Trump-nomics. He doesn't understand the supply side aspects of tax cuts and deregulation. He doesn't understand the importance of strategic energy dominance and the president's ability to dramatically lower oil prices. And he doesn't have a clue about tariffs because in the first term, very clearly, we raised tariffs and there was no inflation. Most of the tariffs got eaten by the foreign countries as we expected.
Well,
the same
Peter,
thing's happening again.
These are not
so
similar
why is
tariffs.
he waiting?
These are much bigger tariffs. We know that. We have
seen absolutely no pass-through of tariffs. It's just not in the data, Jim. And by the way, what's wrong with a more flexible Fed? Why not lower rates and see what happens? What's the big deal?
Because from September through December of last year, they cut rates 4 times, and the long rates went up dramatically, hurting the mortgage rates. We don't want that to happen.
Well, that happened. Okay. Why did he cut rates? He was trying to get Biden or Harris elected. Come on.
Well, we wanted
Come on. That's the partisan aspect of this. And by the way, I mean, look, whether he's let's look at the history. I think the Hill piece is interesting because I go back, talk about how Arthur Burns helped Nixon get elected with easy money. I talked about how Greenspan, and you and I were there, we were in the trenches when he raised rates and killed off the dot-com boom, and we had all that. That was a mistake. We saw Bernanke slow to understand systemic risk, and he let something which could have been manageable get out of control. And look, Jim, there's no question that this stagflation that emerged during the Biden years was not just the product of the Democrats. See the picture behind me, that Capitol Hill where all that bad stuff happened, the Inflation Reduction Act, all of that. That only happens, Jim, if the Fed accommodates that. You go back to William McChesney Martin. I think McChesney Martin and Volcker are the two best Fed chairs. McChesney Martin, when Lyndon Johnson was prosecuting the Vietnam War and wouldn't trade off guns for butter, he said, no, I'm taking away the punch bowl. That's not going to happen. Powell could have spoken up. He should have seen the inflation that just quickly got out of control that we're now tamping back down. So I'm just saying, Jim, he's a lawyer, not an economist, which is an anomaly. The two worst Fed chairs we've had in recent memory were G. William Miller, who was also a lawyer, and now Powell. So I think the case against him, and I would say where Scott Bessent, the little clip you played, it's like, remember, Powell is just part of the board. Right, and so I'm in some sense appealing to the board. It's like, come on, let's get with the program.
I want to let Carl in here because I think you've made your point. I think you made your point of where you feel. I disagree with the ranking, but Carl, there are other issues.
Peter, while we do have you, I've always wanted to ask you for the last 90 days about your comment on April 7th when you said 90 deals were possible in 90 days. We're almost up, and I just wonder, was your thinking at the time that it really was an aspirational number, or are you kind of disappointed in 2 for now?
I'm happy with the progress we've had because every country that we run a major deficit with is fully engaged. I think what we're learning from the negotiations is simply, Carl, how difficult it is for these countries to give up the advantage they have over us. And so therein lies the tale. I think the negotiations are proceeding well. And by the way, the tariff revenues are coming in and really helping this country. And we're able now to get trillions of dollars of investment here to build up our factories and jobs. The tariff revenues are coming in, which help pay for the big, beautiful bill. And I'm very pleased with the direction we're going. We got Howard Lutnick, Jamison Greer, Scott Bessent all engaged in these deals, and the president, of course, at the top of this.
They're your team. Now, I want to go back just for a second. Why, if you're Jay Powell, why not wait to see a couple quarters if there is inflation? What's that going to do to the economy? You've got an incredibly strong economy, Peter. It's remarkable.
So we've already had that argument. We've waited like 2 quarters. As Scott Bessent said, we're behind.
Employment's terrific.
You asked me a direct question. I'm going to give you the answer.
Fair enough.
The answer is simple.
Fair enough.
A 50 basis point lag. If we're up 50 basis points too high, that's a ton of money. That's going to be a half a point of GDP growth slower than we otherwise could and should be. And remember, when you have slower growth, Jim, you have less tax revenues and more debt and deficit, and then you got to finance the whole thing. All these synergies that work with the Trumpnomics, Powell is not allowing to happen, and that's the tragedy here. So he's costing homeowners on their mortgages. He's costing Americans with a credit card debt. He's costing us in terms of our national debt growing. So there's a real opportunity cost for him misreading this.
But now I do want to know, as the trade person, I'm not CEA for trade. We've got some things that disturb me. You have a great American company that arguably has put 2.9 million people to work in our country, which is Apple. It seems like no matter where Apple goes, we find that they have to be taxed high. And I know that they're committing $550 billion to the country. And unless you directly contest Tim Cook's honor, what is enough for you?
Apple, look, Jim, going back to the first Trump term, Tim Cook has continually asked for more time in order to move his factories out of China. I mean, it's the longest running soap opera in Silicon Valley. And my problem with Tim Cook is he never takes the steps to actually do that. And with all these new advanced manufacturing techniques and the way things are moving with AI and things like that, it's inconceivable to me that Tim Cook could not produce his iPhones elsewhere around the world and in this country.
But India
was
something you wanted.
Come on,
at one
it's a
point,
technological
you wanted
problem.
India, you wanted Vietnam. Suddenly, these are not easy decisions. You wanted us to leave China. Apple is trying very hard. They're a huge manufacturer. How about something like this? Apple's a great company, and they're our gem of our country. And what we're going to do is we're going to respect that they moved to India. When it comes to us, we sure wish they would do more, but they're doing $550 billion away from that. What more do we need from this great American company?
Jim, let's simulate that. You and I cannot solve Apple's problems today on this show. What I'm really concerned about is what's going on with the Federal Reserve today. And,
all right. Well, I did want to ask one more thing. We have to see Elon Musk. Obviously, he lost some things in the big bad bill. He has not been as complimentary of you. I know you too long to repeat the things that he said because I don't like that level of discourse. But obviously, you must have a feeling about someone who does not think that you're as intelligent as I've known you for many years and has really, I think, used that kind of derision that I find to be not part of the discourse. What do you say back to him?
Well, here's what I would say about Elon in terms of the big, beautiful bill, which is, I think, where the discourse should stay focused on. If you look at the analytics of this Congressional Budget Office, where they come up with a $2 trillion increase in the debt, it's the same kind of mistake they make that Jay Powell made in the first term. It's like when they scored the bill in 2018, they scored it wrong. They were a point off in GDP growth, and we got all sorts of revenues instead. So when you accurately score the bill, the big, beautiful bill, you get another point of GDP growth, which is a couple of $1 trillion, so the debt comes down. And then when you accurately score the tariff revenues, you get another couple of $1 trillion, and you move from a $5 trillion, it's a $5 trillion thing. You go from a $2 to $3 trillion deficit to a $2 to $3 trillion surplus. And it boggles my mind, Jim, that not enough people are talking about that in the legacy media. Because that's the numbers.
What should not boggle my mind is that people should listen to you and realize that you did not come back with some sort of gratuitous, capricious statement about Elon Musk, and I applaud you. You are the scholar and gentleman that I've known for 50 years. Thank you so much to Peter Navarro.
Always a pleasure to be with you and Carl.
Thank you.
Take care.
Thanks, Peter. As we go to break, take a look at the pre-market futures just south of the flat line.
Let's turn now to Washington and some developments on the trade front, including when higher tariffs could take effect. Megan Casella joins us with the latest there. Hi, Megan.
Hey, Mike, good morning and welcome back, guys, to Trade and Tariff Week at the White House. Once again, we are expecting a lot of movement here just over the next few days. Starting, of course, later today, the president posted overnight on Truth Social that starting at noon today, the U.S. tariff letters and or deals, as he calls them, will be sent to various countries from around the world starting at noon today. This, of course, is the idea we've heard from the president, that he will reach out to countries and let them know the tariff that he says they will have to pay to do business with the U.S. It ends up being a tariff on their exports to the United States, paid for by whoever buys those exports. But he says he's setting those rates as soon as later today. Officials say those letters will be going out over the next 3 days. But Treasury Secretary Scott Bessent told CNBC this morning that there is potentially still some time to negotiate and that new offers are still coming in. Take a listen.
My mailbox was full last night with a lot of new offers, a lot of new proposals. So it's going to be a busy couple of days. But importantly, too, that President Trump has said that the countries would not go back to the reciprocal rate until August 1st.
So effectively moving the goalposts again there, guys, to August 1st from July 9th, which initially had been the deadline for these higher tariffs to take effect. Now, just one point of clarity on that. The July 9th deadline for the reciprocal rates to kick back in is written into law via executive order. So one question I'm asking here today and trying to get clarity on still is whether we'll see new text in order to change that. Otherwise, they say now they're not taking effect until August 1st. Guys.
Megan, do we know more about the idea of the BRIC countries and whether they could face additional tariffs if they align with, quote, anti-American policies?
Yes, that was a new Truth Social post that came out overnight as well after the BRICS countries this weekend put out a statement following their joint conference saying that they weren't exactly a fan of unilateral tariffs. The president then saying anybody that aligned with that would see a 10% higher tariff additional on top of anything that was already in place. Now, we haven't seen formal text on that, and we would have to see something there in order for that to take effect. But a lot of questions there. China, of course, aligned with the BRICS countries. Would they go from the 145% where we are now to 155%. You would think that would be the next step. What does that then mean for this very fragile trade framework that we do have with China? Same with India, for example. Officials have been saying for weeks now they're very close with India. If just overnight the U.S. was raising that tariff rate another 10%, you do wonder what that means for those negotiations as well. So we'll wait to see if we get any text on that, but that is the latest proclamation from the president on that.
Yeah, and of course the RM BRICS being Russia, and there's supposed to be an embargo. I mean, it's kind of messy all around. Megan, thanks for keeping track of it for us.